Hello, everyone out there in podcast land. Welcome back to Adventure Capital, where we not only discuss the entrepreneurial journeys and adventures with founders who have raised capital on WeFunder, but also the different resource providers and mentors helping founders along the way. Huzzah! In this episode, Johnny interviews Elliot Begoun, the founder of TIG Brands, a venture studio that helps CPG founders scale. Elliot's been a partner of WeFunder for a number of years, embracing the concept of raising capital from your customers before it was cool. WeFunder gang, take it away.
Johnny Price here on the WeFunder team. Today on the podcast, we're delighted to be joined by Elliot Begoun, founder of TIG Brands. Elliot, welcome to the podcast.
Thanks, Johnny. Glad to be here.
Maybe you can start by just giving everyone a quick overview of what you guys do at TIG Brands.
Sure. I always like to start with the why we do what we do, because it's almost a better precursor. I mean, here's two important stats, and these are all study dependent, but somewhere in the neighborhood of $18 billion of market share from 2009 to 19 moved from the top 25 CPG brands to smaller entrepreneurial emerging brands. Yet during that same time frame, again, you pick your study, somewhere between 80 to 90% of the brands that start were gone within 2 years, and that was maddening. So I felt compelled to change those odds, that 80 to 90% failure rate, and so we built TIG Brands specifically to fight that fight. And we offer two programs. One is our take on a venture studio approach, which is, identifying brands that we think are optimized and ready or are ready to scale, and come in and help them optimize to do so, making sure that they have the necessary capital and team and strategic support and foster community, particular community of collaborators and champions, and make sure they have access to the people that can actually make things happen. And then we have a community program, which is really aimed at founders and entrepreneurs of all sizes. And it's education based, there's workshops, there's mastermind groups, and it's just a way to build deeper collaboration, deeper education, and hopefully help founders avoid some of the pitfalls and challenges that exist in this, difficult minefield of a business.
Cool. And we'll come back to dig a little more into both of those models in a few minutes. But maybe before we get there, how did you, Elliot, come to be running TIG Brands? What's the personal background?
This is my 32nd year in the industry. So, which means I
thought you were going to say 32nd year on planet Earth, man.
Yeah.
You could afford.
Well, it's probably of consciousness, but I mean, 32nd year in this industry. And, I started this really kind of arrogantly thinking, well, at the time I started a career's worth of amassed experiences and C-suites, and made a lot of mistakes and saw a lot of things happen. And then I could come in and teach. And what I've learned over time is I spend way more of my day as a student than I do as a teacher, and then I just get to cross-pollinate. But I've been in CPG for 32 years, and when it was finally time to kind of sow my entrepreneurial oats, I realized, oh shit, I'm too old. I've been doing this too long. I can't see myself standing on a trade show floor or trying to start a brand. So let me just come alongside the entrepreneurs who are doing it and help them win.
Very cool. And so how long has TIG Brands been around now?
This is, we've been around for 8 years.
And so, give us the story. I'm curious how the model has evolved during those 8 years, and kind of what you've learned along the way as a student, as you say, of the entrepreneurs that you're supposed to be teaching.
Yeah. I mean, it's kind of a fun story for me to tell, because I started this business really as your typical consultancy, and then realized I sucked as a consultant. I didn't do well standing on the sidelines, and it just wasn't a role I relished. And truthfully, I looked up one day and said, wow, I've worked myself into 4 or 5 part-time jobs. It's not what I wanted to do. And I was at Stanford's D School, their Center for Human Centered Design. And I was kind of just commenting in passing around, the accelerator models and incubator models that exist, that CPG was trying to rob from tech. And the reality is, CPG is very, very different from tech. It's far more emotive. Every brand, every category is very idiosyncratic things. And when you try to distill things down to cohort, curriculum, time limited, all those kind of things, it just doesn't work. And the professor looked at me and said, well, you are here at the D school. Why don't you actually design something different? And that's what we did. We wound up grabbing 6 founders who were emblematic of the kind of founders and brands we wanted to work with, and said, be our focus group, and we'll give you some advisory support, and you give us honest, no bullshit feedback about what matters and what works for you. We want to build a different model, and that's what we did, and that's what led us to the model. The first model that I mentioned, kind of our take on a venture studio model, and the second, the community, the Tardigrade program, was really built in response to what was going on after the outbreak of COVID, and the recognition that there were going to be a lot of new brands as people were shaken out of their nest, and a lot of brands trying to figure things out in very tumultuous times.
On the venture studio side, can you be go into a little more detail on what does the, I don't know if it's right to call it a program, but what does the experience look like for the founders that you're working with? What kind of support are you providing? What kind of engagement? Like, how long is that engagement?
Yeah, sure. Happy to. I mean, brands apply to come into the program, and we look at it through our team and really evaluate if one, that brand is truly ready to scale, and if we are the right team to help them scale.
How do you evaluate? What are the criteria that you look at to say, okay, yeah, this CPG company, this founder is ready to scale?
Well, I mean, from the brand and the product itself, we look at everything from unit economics to the category data, where the brand sits in the category. Is it a me too? Is there differentiation? Things along those lines. But we also spend a lot of time before we pull the trigger with the founder itself to make sure that, there's a balance between being, malleable and confident, right? And you have to find those founders that are the good blend of the two, right? That they'll argue for what they firmly believe. They have a strong opinion, but they hold it loosely enough to be adjusted. And so that's a big part of it. But you asked about length of the program. One of the really important elements of our program is that either party has a ripcord, simple 30-day out at any point in time. And what that does, at least in my experience, is it basically necessitates that both sides see value in the other, that there's a benefit there, and that we're not working out of some obligatory contract or anything along those lines. We're working because there's true value. So there are times where we're wrong, and we'll pull that ripcord 6-9 months into a relationship just because we're not able to affect the change that we want to see happen.
When you say venture studio, that implies like there's a big kind of equity ownership. So
we do it very differently. So rather than a straight equity mandate or a percentage shares, what we do is we work on a stakeholder fee that's a gain share program. It's based on the incremental revenue that together we create. So we take the baseline trailing 12 months, and each month the incremental revenue we take a portion of. But
I love that. When I was at Kiva.org, which I don't know if we ever talked about this, but I used to run the US team at this nonprofit called Kiva.org. It's doing crowdfunded microloans. But I had this idea of starting because there's all these nonprofits that are doing technical assistance in quotes for mom and pop shops throughout the country. And I had the idea of starting one that was like, doing that exact compensation structure where it's like, you are going to pay us because a lot of these programs are for free, and that's problematic because then like, how do you ensure that it's like, valuable services that are being provided to founders that they would actually pay for and are getting value from if there's no price mechanism, feedback loop. But like, so there would be a kind of payment, a fee, but it would only be triggered by success. And I didn't actually know that was your.
Well, two things I'll say to that. One is we've learned too that when there isn't the pain involved in writing a check, there isn't the commitment that's necessary to succeed.
Exactly.
But the other element that we do to that is that we also give our our founders the option, and it's their option, to defer 50% of any fee that they pay us into an accumulating safe. And it's a pretty founder-friendly safe.
And that's their option to do that?
It's their option. It's not a mandate.
They want the cash flow.
If they want the cash flow, and our safe is uncapped. It's just a 20% straight.
Wow, that's
discount.
awesome.
So it's a very founder-friendly way, and we share that. All of our team vests in that.
That's super cool.
So it's a good way to share it too. So
how many people is on your team now?
there's 5 of us.
And how many founders are you working with right now, or are now kind of, you know,
in the Tardigrade program, and I'll tell you a little bit about why we call it Tardigrade. We cap it at 20 founders. In the membership program, that is a one-to-many solution. So that's open-ended. There's about 40 in it today.
And yeah, I was always curious about that. Why is it called Tardigrade?
So 3 or 4 years ago, I was writing an article about the fact that as an industry, we celebrate unicorns, and you know, they really are few and far between. They're close to mythical, and that there is an alternative way to build brands that are more committed to being nimble and capital efficient and resilient and so forth. So I was looking for an antithetical mascot to the unicorn, and I started reading about this microscopic tardigrade that can curl up into cryptobiosis and slow its metabolic rate to 1/10%, survive for 30 years without food or water, and can live the bottom of the ocean or on the moon. And those are the frickin' brands I want to build. These incredibly resilient, tough.
Yeah, so basically you're saying, okay, if you work with Elliot and the TIG Brands team, then you're not going to grow at all for 30 years. Is that right?
Not quite, but you're not. You're also not going to die quickly. So
couldn't resist that little dig there.
No, it was a good dig, Johnny. I would have done the same for you.
Well, I just looked up some pictures of the tardigrade, and it's an interesting looking creature.
Yeah.
I love that. Yeah, I love that you just have so much fun with your kind of branding, and I feel like you're so kind of irreverent and like poking the bear, and just like I think that's why we get on.
I think we spend way too much. I spent way too much of my career in a suit and tie, walking the walk, doing all of that, and that's just doesn't interest me at all. And we take ourselves way too seriously, period. And I don't have a lot of desire for that anymore in my life. I want to have a good time.
It's very surprising to me to hear you say that, because I mean, this is an audio only podcast, but you're there in the Hawaiian shirt. It's kind of, you're showing a bit of chest hair there. Got the Bono shades. You got a rock star vibe going on. So it feels, I'm sure you're in a lot better place now. Me too, man. I'm like, shorts and flip flops is the uniform these days.
That's it.
Suits I used to wear in consulting.
I mean, my true hack is I have a creative on our team, Wave and Dean, who literally dresses me now. So because my wife gave up all hope, and so
that's what I need. I need a professional, makeup artist to
we all need a good creative like that.
What's your you say you've been doing this for 8 years. You've seen probably at this point hundreds of startups up close. What are some of the biggest let's say mistakes that you've seen? Okay, and I'm curious, like when do you start working with companies? When does that kind of relationship kind of end? Does it end? And then in that kind of stage that you're working with founders, CBD founders, what are some of the biggest mistakes you've seen them make?
In our kind of take on a venture studio program, most of those brands coming to us are pre-seed stage, $1 million, maybe even sub $1 million and trailing 12. And they're usually with us through Series A or B, but as mentioned, they can pick off when there isn't value. We've had brands that have been with us for over 7 years, so it really depends. But the mistakes, the common things that I see time and time again, first of all, is not understanding discernible differentiation. I mean, that's for any product, any brand. But if you're going to show up and win consumers, you've got to be different. You can't just be another brand. And the other two things that I see is a misunderstanding or a lack of prioritization on true unit economics, right? I hear this all the time. When we get to scale, our cost of goods will be right. Our margins will be right when we do that. But that is never how it works out, because guess what happens as you grow to ubiquity? You experience price compression. So you got to understand your unit economics.
Retailers are squeezing you.
Yeah, everybody does. And then the third is that, is just being mindful of the I say this probably too often, but growth is the most voracious consumer of capital. And so if you just grow for the sake of growth and you don't have it connected with a really good capital plan, you're going to find yourself out in that proverbial valley of death where so many brands find themselves, where you don't have the resources to either go back or to go forward. You're just going to die, or you're going to make a terrible decision. You're going to, agree to the wrong kind of investment terms, the wrong kind of investor, or you're going to, take out a second or third mortgage on your home and ruin your marriage. I mean, it's just, that's where bad things happen. And so those are the things that really concern me. Be differentiated, pay real attention to unit economics, and be metered and smart about your approach to growth.
On the differentiation piece, what are the best ways to differentiate? Because it's kind of easier maybe to think about moats, or I don't know if that's true. It seems to me like moats are maybe kind of easier in like the kind of tech world versus the CPG world. Maybe that's
well, it is. I mean, it's a little bit harder to carve out things like IP in the CPG world, especially in food, bev, personal.
Like network effects, right? If you're a two-sided marketplace, and network effects are a huge moat. Like WeFunder now has a moat because if we have 1.4 million registered users, more than any other platform, then that's a pretty compelling reason why a founder would raise with us versus our competitors. But
I love the way you worked that plug-in, Johnny. That was good. That was master.
God, I thought I snuck that in there. You're going to let that slide, but that was a revenge for the 30 years of zero growth tardigrade comment. But okay, now we're even. Let's have a truce. Okay, best kind of ways for CPG companies to differentiate.
I don't know that there is necessarily best way. It has to be the best way that's true to that brand. So obviously product, and having different
taste,
and taste is a hard one. I mean, really, I love packaging that says, great tasting or something. I mean, I would tell you, if you're going to put that on your package, you're better off putting something like tastes like shit on the package, because the expectation of a consumer in any product is going to taste good. So don't call it out. So that's what I mean by meaningful differentiation. So differentiation in consumer, because it is a motive, could also be, what you stand for, how you show up, how you communicate or engage with your consumer, what you do. All of those things are just as important as the product or the package or anything along those lines. So it could be product innovation, could be package innovation, but it could also be messaging innovation, or just, emotive innovation or differentiation. So you just have to have something that carves out. I mean, the thing that just came to mind is like Bombas socks, right? Buy one, give one. The socks are good. They're good socks, but that isn't enough of a differentiation. But what is their differentiation is the way they show up from a social perspective, and that you want to do it. Same with Patagonia is another good example. It isn't the product that is so highly differentiated. They make great products, but it's what they stand for, what they do, and so forth. So you just have to understand what your swim lane of differentiation is, what you can actually do, and do it. But you have to have a compelling reason to buy. And what you don't want to do for a retailer, for anybody else, is just be something that's cannibalistic either. I mean, you go to a retailer and say, I have the next great potato chip. But if your next great potato chip just means they buy yours instead of somebody else's, you're not really doing anything for them.
Right.
So
one question that I've been thinking a bit about recently on the WeFunder side is that the product versus marketing question, right? Is it like, if you build it, they will come, or is it all about distribution? In the world of fast growing CPG brands that are trying to steal market share from, you know, their kind of bigger General Mills kind of incumbent competition. What's the kind of percentage breakdown on, is it product or marketing distribution?
I think where I see too common is that you know, the battle is getting on the shelf, and that's where a lot of CPG, you know, young brands go, is that they fight hard and they get on a lot of shelves. The war is getting off the shelf, right? That's the hard thing. And so it really comes down to being able to activate your brand and being able to activate your customer. And
getting off the shelf means the consumer who's shopping in Whole Foods like takes that product off the shelf and puts it in their cart.
That's right. I mean, so you can get Whole Foods to put it on.
It could also be kind of distribution and marketing, right? Or is the product in the CPG world, is the product, I guess the product is also the packaging, maybe.
Yeah, I mean, the product is the whole thing. It's the package, it's the products inside of it, it's the ingredient components of it, it's the way it's presented. But, you know, talking about from a brick and mortar perspective, you know, getting it on the shelf, it's a little bit of a pay to play industry. And if you have a compelling case and a retailer see an opportunity to maybe create something that's accretive, you'll get it on the shelf. But that is, I mean, it's not easy, but that is a lot easier than getting, you know, the consumer who's walking down that aisle, who's surveying, you know, 3 feet in 3 seconds to reach to that shelf, get that product, put it in their cart, and do it time and time again. And if you
also more easy to get the Whole Foods buyer to put it on the shelf if, you know, it tastes great. There is a clear kind of differentiation versus other products in the category. It is accretive to their, you know, whatever like category, like, you know, range and economics, right? So that's why the product kind of can drive the distribution as well, right?
That's right. I mean, ideally, if you can show traction, you can answer all of those questions as to what your presence or what that product's presence in that category does for the category manager, you're going to get a yes. But you got to be able then to deliver it, because, you know, they don't waste time. Retail is a real estate business. At the end of the day, what they're selling is linear feet, and what they're looking for is the best return per linear foot, you know. And if you don't show that return, then
I used to do that. When I was in consulting, I did a lot of work in retail, and we would work with supermarkets and basically help them optimize their range. And it's all about the velocity, and so.
Now you complicate it with the interrelationship with D2C and
online. When I was doing it, that was kind of a lot smaller percentage.
And you know, we talk about this all the time. You know, entrepreneurs think about it. You know, in this industry and in a lot of industries, you talk about channel strategy and you talk about what channel you're going to do. And you know, so I'm going to be in, you know, specialty natural grocery like Whole Foods, and I'm going to be mass market like, you know, Walmart or Target, and, you know, et cetera. But that's not how consumers shop. I mean, we just go out and buy things, right? And so we shop up and down a continuum. One end of it is where we discover, another end is where we replenish. The smart brand, the smart entrepreneurs figure out where they can intersect that continuum in the most capital efficient way to drive both discovery and replenishment. And in this new world where you've got, you know, e-commerce, third-party platforms, e-tailers, physical brick and mortar, all these different, you can be innovative. You know, that's the one you asked about mistake. Another mistake, I think, is sometimes entrepreneurs check innovation after their product, right? They stop. They're really super innovative. They created something cool, but then they just go out and do what everybody else does in terms of how they take it to market, instead of continuing that kind of innovator's mindset and try to think about, you know, how can I do it differently from everybody else? Where can I take it that makes more sense?
Want to talk a little about the capital side of the journey for CPG startups. One thing maybe the only thing, Elliot, that I like about you is that you're a
I'll
fan
take it.
of
I'll cling to what I can get, Johnny. I'm
these
not too
community
proud.
rounds. I wouldn't be your friend if you didn't like this WeFunder and these community rounds. But yeah, you've referred a bunch of founders our way. I feel like you're a champion and supporter of what we're doing at WeFunder. Why is that?
Well, you, of course. No, I mean, in all seriousness, for a lot of reasons. First of all, just talk about the macro, trends in this space around capital, right? On the the larger VCs have gotten larger and larger. The size of the funds have gone up, and as fund size goes up, fund economics mandate that they've got to deploy more money more effectively,
So it's
quicker.
later stage.
And so it's later stage. So there's been this growing funding gap, for brands that are, let's call it sub $5 to $10 million. It's harder to find and win investment. And so platforms like WeFunder, give them another really viable option. The other challenge that I have is just is a philosophical one, and that is, the way things work today is, for most people to invest in these kind of emerging brands, you have to be an accredited investor. So you're giving wealth building opportunities only to the people who have already built wealth. And, a platform like WeFunder democratizes that. You invite both accredited and non-accredited investors. So you're giving wealth building opportunities to the people who really do need the opportunity to build wealth. And then the third is that, it puts the onus on the founders, the brands, the products to really be able to optimize and clarify their reason for being. And if they can activate their community, their tribe to come separate them from their dollars in a way that invests, two things happen. One is you've got more confidence in your ability to market your product and activate your consumers, but you're also creating an evangelical tribe of followers who are going to, help you grow your brand, are going to talk about your brand, are going to do things. So, for all those reasons, I am a fan. I am a supporter. I'd like to, one of the things I'm trying to do is also encourage all the participants in our industry to give back to these early brands and make sure they're doing it. And platform like WeFunder allows for that too.
I love that. And just going back to your first kind of mistake that you've seen founders make of lacking differentiation. One of the ways that I think, company can kind of differentiate is to say we are owned by our customers, and I don't know if this is differentiation so much as like, a way to win and get a higher share of customers' wallet. But if you're kind of making gin and there's like tons of potential like gins in the category, if you're the gin that has a bunch of your customers as investors in your company, they're going to spend a higher percentage of their monthly gin budget on your brand versus your competitor's brand. So yeah, which is kind of what you're getting at with the evangelical tribe thing.
I agree.
Well, yeah, seriously, man, it's been so great working with you over the last few years. We've collaborated in a number of ways, and just really, it's hard when you're kind of, blazing a new trail, right, and kind of pioneering a new way of, in this case, raising capital. It can be lonely, and so to have people that now it's becoming more and more, I would say, kind of common and prestigious, and there's kind of less and less pushback. But I feel like you've been a champion and an ally from for multiple years, so really do appreciate that.
Well, it's my pleasure, but it's certainly not. It wasn't because it's altruistic. It's because I really feel and again, this is not me throwing you a softball. It's true. I and this is such an important tool in an entrepreneur's chest to be able to activate their community, to be able to raise money in a democratized way, and it's just needed out there. It needs to be even more vibrant than it is. It's still harder than I would like it to be. I mean, we've got 3 of our brands right now raising on WeFunder: Tia Lapita, Riff, and Spinster Sisters. These are all great growing brands, all doing something, either fighting for social justice, climate action, human wellness, something along those lines. And it's still not easy for them to build this community in as quick a fashion. So the more people that begin to get aware of this, I mean, one of the things that we've talked about too is we have to educate the other aspects, the older guard of the industry, right? The attorneys who are afraid of cap table complexities that existed before the more recent changes to Regulation C. All of those kind of things. We're making headway, but the more people that can participate in an ecosystem like this and help these brands, at the end of the day, what we're going to do is we're going to wind up with the ability to buy more products that stand for what we want in this, entrepreneurs of diversity. I mean, that's the other challenge too, is this is another way to bring more diversity to, not only in founders, but of investors. So instead of a bunch of middle-aged white guys like me.
Or me. If you have more diverse investors, then you get more capital flowing to diverse founders, or at least that's the plan and what we are seeing. Well, on the kind of, you mentioned lawyers there, but I mean, VCs will be another category, right? We're seeing some really cool stuff now, where I'm having more and more conversations with VCs, where 2 or 3 years ago, as you say, it would have been like, equity crowdfunding is bad. And now, and we're trying to rebrand that as a community round, right? Which I think helps with this conversation. But now it's not just like equity crowdfunding or community rounds are not bad anymore. But I'm actually having more conversations with VCs where it's like, okay, I actually want you to talk to my portfolio companies because, okay, Johnny, I actually buy your idea that if my portfolio companies can allocate some part of every round or some part of their equity to their customers and community, then that will actually accelerate their growth, which is very good for me as a VC investor in that company. And so it's not just like with the kind of elimination of the negative, but now it's actually like the embrace of like, oh wow, this can be a real positive, which if we get there and that happens more and more, and this community round launch that we have coming up in a couple of weeks here, I think this is really going to accelerate that. So that for me is the future. And if we get to that world where it's just so commonly understood and believed that bringing on your customers and community as investors is going to do good things for your LTV, reduce your churn, increase NPS, all the metrics, then I think that's going to be where this thing becomes.
Yeah, I mean, if I'm as an investor on my end, I look at it too as it's a de-risking activity, because if you can prove salience, prove that you can extract money from the people you're trying to be be consumers, then I'm seeing that as another proof point to traction. And
it's a proof point to traction in terms of like selection and almost like due diligence. But then also once those people invest, then it should improve their trajectory going forward. Absolutely. Because they're going to spend more.
You got your tribe, you got your community, and I love the use of community round. I think it clarifies it and different. We talked about differentiation. I think it helps differentiate this between what was when most people still the unexposed hear crowdfunding and they think of rewards based crowdfunding or something like that.
Go to Kickstarter, yeah.
This is such a different thing. So I think a community round is just part of a capital, your capital strategy. So
just to pick up on something you said before as well, the altruistic thing, you said like it's not altruism, right, that you've embraced this way of raising capital. I love that. I've been giving this example recently of organic food, right? The CAGR of organic food over the last 2 or 3 decades has massively outpaced the CAGR of non-organic food, right? And yes, that's better for the environment. But I think the reason why the CAGR has been so high on organic food is because people believe it's better for them. It's better for your body to put organic food in than non-organic food. And so it's better for your health. And so it's people's self-interest that's driving the kind of much faster growth of organic food. And that's my hope with WeFunder is that, yeah, as you were saying, I think it's good for our society and good for a more kind of equitable distribution of wealth if it's ordinary middle-class Americans that get to participate in the next, kind of explosive brands and the wealth that creates. That's good for the world. But also, hopefully, it's in the narrow economic self-interest of the founder to raise money in this way, because then those customers are going to spend more money and tell more people, and that's going to kind of be good for their economics. And that's actually what's going to really drive the growth of community rounds as a way of raising capital.
Well, and also, if you are a person, an entrepreneur who's raised a community round, participating in the raise of others raising is critical. And that's what we've been pushing on.
Yeah.
And with one of the cool thing is I know a bunch of our entrepreneurs have invested in the brands that are on there. They're supporting each other, and that's cool too.
What's the future hold for TIG brands?
We're doing a lot of cool things this year. One of the things that we're doing is we've started what's called an advisory collective, where brands can opt in to provide advisors shares, and then it goes into a collective, and we have pulled together a cadre of amazing subject matter experts and people that have been on this journey. And the goal of doing that is to try to create more diversity on boards and more diversity of really cool advisors. So really cool, prioritization of women and BIPOC advisors, and get these early brands surrounded by great advisors, help advisors learn the art of being an advisor and how to be a board member eventually, teaching governance and fiduciary responsibility, and then working with entrepreneurs, how best to manage a board, how much best to extract. So cool about that. We're excited about that program. We are launching a fund really aimed at those pre-seed stage to try to do our part to participate more robustly in early stage funding, and certainly anticipate being the lead investor in a lot of the folks that go through your platform to do it.
Awesome.
And then we're also doing kind of cool thing now that the world is beginning to open up. We're doing some really cool on sites where we're renting a cool house in the Hollywood Hills, and we're bringing in retailers and founders and putting people.
Oh, that's amazing, man.
Putting people up by a pool. Yeah, and just having really collaborative, non-transactional conversations, because the only thing we do anymore now is the transactional conversation. So how do we take it away from that?
That's super cool. Did my invite get lost in the post? Because I don't think I've received the invite to that mansion.
Well, I think for years we got to come to we got to rent a place in Nashville. So.
Oh, there you go. Yeah. We'll hit up Broadway together.
There we go.
Elliot, this has been great. One question we ask everyone. One piece of advice, if you can distill it down to one, that you would kind of give to CPG founders that are that kind of pre-seed stage that you're starting to work with.
I would say most importantly is understand that capital efficiency is the most important element of resilience. So really recognizing every dollar that you deploy, what's the return of that dollar deployment? That's going to extend your runway. That's going to allow you to make, the necessary mistakes that come with it. But if you're just absolutely dogged about your pursuit of being extraordinarily efficient with the use of your capital, you're going to wind up being more nimble. You're going to wind up being more resilient.
Let me just kind of ask you a bit of a follow-up on that. Just does that then sometimes, is there a risk that trying to kind of tie back the return on that dollar spend, is there a risk that it causes founders to be, to be less kind of, I don't know what the word is, like exploratory or expansive, or kind of, because sometimes, right, it's tough to tie like the results
Well, I'm not specifically talking about just ROI to ROI, but if, to answer that specifically, capital efficiency to me is, instead of just trying something exploratory, you run growth hack experiments that are small and controlled to validate your assumptions first before you throw a bunch of money against something, hoping that it works. So that's being capital,
It's like a lead approach, an MVP.
You still have to be risk taking, but those risks can be mitigated by the size of them, and and also done so in a way that is actually going to exact the information that you need to be better and to build from.
Yeah. And probably the way that you measure ROI doesn't necessarily need to be where you can actually see the results. Sometimes it's maybe intuition.
Oh, 100%. I'm not, when I say, taking a look, what's the path to return on that, that capital, and the length of that, and understanding, just having that front of mind is important. It's not saying, this marketing activity is going to return this dollar in revenue on this.
Right.
That's impossible to do, but you need to have a pathway. You need to have a belief that, and then how do you make a smaller bet to validate it?
Right. Love that.
Yeah.
Cool. That's a really awesome note to end on. Elliot, this has been a really, really fun conversation.
How could it not be, Johnny? It's you and me, man.
Speak to you soon. We'll see you in that mansion when my invite arrives.
There you go. You got it.
Cheers. Bye-bye.
Bye.
Thank you for tuning into another episode of Adventure Capital. I hope you laughed, took notes, shed a tear, and most importantly, feel ready to go off on your own adventure. And remember, whenever you're ready, WeFunder's here to help. Be sure to like and leave a review, gang.